This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the major events for this week, beginning February 1st. The main highlights of the week will be the Reserve Bank of Australia meeting on Tuesday, the US ADP report on Wednesday, a Super Thursday for the Bank of England on Thursday, of course, and the US employment data on Friday. We're starting out today with the final purchasing managers indices for January. They aren't looking so good. In particular, China's official manufacturing PMI fell by more than expected, although the Caixin market PMI was up by more than expected, and that one seems to have more credibility. In any case, though, they're both well below the 50 line and so aren't encouraging. Later in the day, we have the U.S. personal income and expenditure for December and the ISM manufacturing PMI. Both income and expenditure growth are expected to slow, adding to the string of negative U.S. indicators. On the other hand, the personal consumption expenditure deflator, the Fed's preferred gauge of inflation, is predicted to accelerate somewhat, and that would be bullish for the dollar. As for the ISM index, it's expected to rise a bit, but to remain below 50, once again, another piece of data suggesting that the Fed moved too early. On Tuesday, the RBA meets. A Bloomberg survey showed only 3 out of 27 economists calling for a cut. Last week's stronger than expected fourth quarter CPI data probably ruled out a cut. Like most other central banks nowadays, then, it'll be probably more about what they say than what they do. At their last meeting in December, they judged that conditions had improved a bit, but also said that, quote, the outlook for inflation may afford scope for further easing of policy, unquote. Given the slowdown in China, they could move to more active easing bias, which would be negative for the Australian dollar. On Wednesday, the monthly ADP report comes out, as usual, 2 days before the non-farm payrolls. It's not a very good predictor of the preliminary payroll figure, but it's the only thing we have. The market is expecting it to show an increase of 190,000 jobs, which is below the recent average, but it'd be enough to keep the Fed on a tightening course. That would therefore be bullish for the dollar. Thursday is Super Thursday for the UK, when the Bank of England Monetary Policy Committee meets. They release the minutes, of course, and the bank also releases its quarterly inflation report. The MPC meeting is usually a non-event, as the voting is always the same, but the minutes are worth some attention. This time around, Bank of England Governor Carney will give a press conference following the release of the inflation report. That'll probably be the highlight. He'll no doubt get some questions about how the Brexit vote could influence monetary policy and whether negative interest rates are in store for the UK following the Japanese decision. Friday, of course, will be dominated by waiting for the January non-farm payrolls figure. Strong employment data should encourage the Fed to keep hiking, while any weakness might convince them to stand pat for longer than they expect to. The market's looking for a rise in payrolls of 190,000. That's a bit below the recent trend, but it would be quite reasonable after the enormous increases in payrolls in December and October. Average hourly earnings, which is also released at the same time, is carrying greater significance nowadays because one of the Fed's big worries is the lack of growth in wages. Growth in average earnings is forecast to slow, or to have slowed in January, which could be negative for the dollar, even if payrolls hit their target. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.